Everyone is chasing the same handful of tech stocks, but the latest filings show Warren Buffett just made a move into old-school billboards. That's right, he's reportedly in on Lamar Advertising. So the big question today is this a genius contrarian signal to buy, or is the company's massive debt and competition from giants like Google and Facebook a disaster waiting to happen? Hey everyone, welcome to the debate. Our goal is simple: to cut through the market noise and give you the clear analysis you need. Let's get right into it.
All right, let's talk about why LAMR, Lamar Advertising, is absolutely worth your investment dollars right now. First, what does this company actually do? Think of those massive billboards you see driving down the highway. Lamar owns over 360,000 of them across America and Canada. They're the king of outdoor advertising with a simple but brilliant business model. Rent billboard space to advertisers and collect steady monthly payments. Their revenue comes from three main buckets: about 76% from traditional and digital billboards, 14% from transit advertising like bus stops and airports, and 10% from specialty advertising. But here's where it gets exciting. This isn't your grandfather's billboard company anymore. Lamar is absolutely crushing it in the digital transformation game. They currently have about 5,000 digital billboards out of their 159,000 total inventory. That's only 3%, but here's the kicker. Those digital billboards generate 32% of their entire revenue. When they convert a static billboard to digital, revenue jumps from $3,000 per month to $15,000 to $18,000 per month. That's a 5 to 6 times increase. And they're not slowing down. Lamar plans to add 350 to 375 new digital displays in 2025 alone. Each conversion costs about $200,000 but pays for itself incredibly fast. Now here's why this matters for your portfolio. Lamar dominates the U.S. market with 55% market share, way ahead of competitors like Outfront Media. They're positioned perfectly for the massive shift toward programmatic advertising. That's where AI automatically buys and optimizes ad placements in real time. The global programmatic outdoor advertising market is exploding, growing 16.4% in 2024 to $1.42 billion, and Lamar has the largest digital network to capitalize on this. Plus, you're getting paid while you wait. Lamar offers a juicy 5% dividend yield that's double the S&P 500 average, with 5 straight years of dividend growth. Their cash flow is rock solid with EBITDA hitting $1 billion in 2024. The outdoor advertising market is expected to reach $73 billion by 2033, growing at 8.3% annually. Lamar isn't just riding this wave, they're leading it with the best digital infrastructure in America. This is a classic dividend aristocrat with massive digital growth potential. You get steady income today plus explosive upside as they convert more billboards to digital and capture the programmatic advertising boom. That's why Lamar is a compelling buy right now.
Let's cut through the hype and look at what really matters for your money. First, Lamar Advertising may own loads of billboards, and yes, they're adding digital screens, but behind the shiny digital transformation is a serious debt problem. Their debt-to-equity ratio has skyrocketed to over 500%, meaning most of their growth is financed by borrowing, not by actual profits. When a company borrows this much just to expand, it puts your investment at real risk. Think about it. When interest rates climb, or if revenue dips, who's left holding the bag? Everyday investors. Second, this business is not recession-proof like some claim. Outdoor advertising is extremely cyclical. When the economy cools or businesses cut budgets, ad spending is the first thing to go. We're in a world where recessions come fast, and during downturns, Lamar's revenue takes a hit. With all that debt, the risk goes up even more. Third, let's talk expenses. Lamar needs to spend huge amounts just to maintain its billboard network, not even grow it. We're talking hundreds of millions in maintenance capital expenditure every year. That money doesn't fuel growth, it just stops things from falling apart. It eats into profits and limits how much can be returned to shareholders. Digital billboards? Sure, they bring higher revenue, but the cost to convert and maintain them are gigantic, and competitors are racing to catch up. Meanwhile, measurement and targeting in outdoor ads are still miles behind digital platforms like Google and Facebook. Bottom line, Lamar's business might look stable, But the combination of massive debt, economic risks, and huge maintenance costs makes it a shaky bet. Your hard-earned money deserves better risk protection and growth opportunities.
Thanks for those points, they deserve real answers. Let's face the facts head on. First, about debt. Yes, Lamar's debt-to-equity ratio is high, but that's pretty normal for a real estate investment trust, REIT. Most of their debt is long-term and fixed rate. They recently refinanced to lower interest costs and keep debt manageable. Plus, even with higher rates, Lamar's annual cash flow covers interest payments nearly 5 times over, so the risk is much less than it looks. Second, is Lamar recession-proof? No business is totally immune, but Lamar's track record shows outdoor ads bounce back quickly. In 2020's lockdowns, revenue dropped and then rebounded to record highs in just 2 years. That's because local businesses, political campaigns, fast food chains, and big brands all need outdoor ads to reach everyday people, especially when online gets crowded and expensive. Third, let's talk costs. Sure, maintaining billboards costs real money, but those assets last for decades, and Lamar owns most of its locations. For every $200,000 spent converting a billboard to digital, revenue goes up 5-fold and the payback period is less than 2 years. That's not just keeping the lights on, that's investing for the future. On targeting, Lamar's digital billboards are now powered by AI, the same tech used in online ads. Advertisers can change content in real time and measure local impact, closing the gap with Google and Facebook. Bottom line, Lamar isn't just stable, it's resilient. You get reliable dividends, real estate assets, and exposure to digital growth. If you want solid returns with less drama, Lamar stands out from the crowd.
Thanks. My opponent makes some interesting points, but let's peel back the layers and look at the reality for everyday investors. First, this argument that high debt is normal for a REIT misses the point. A REIT that owns apartment buildings gets rent checks. Even in a recession, people always need a place to live. Lamar rents billboard space to businesses, and when a recession hits, advertising is the first budget that gets slashed. That safe cash flow they mentioned can get shaky really fast, and that mountain of debt suddenly looks a lot more dangerous. It's a cyclical business with high fixed costs, a risky combination. Second, comparing the post-2020 rebound to a typical recession is misleading. That recovery was fueled by trillions in government stimulus and a unique "we're opening" boom. The next economic downturn won't have that safety net. Today, Lamar isn't just competing with other billboards. It's fighting against Google, Meta, and TikTok for every single advertising dollar. Those platforms offer something Lamar never can: precise data on who saw an ad and whether they bought something. Finally, let's be honest about the digital revolution. They talk about a quick payback on new digital signs. But that ignores a huge risk. As more billboards go digital, the supply increases, and that premium revenue they're bragging about will shrink. It's basic economics. Furthermore, calling their targeting AI-powered to rival Facebook is a stretch. A billboard can't follow a customer home to see if they made a purchase. So when you look past the sales pitch, you see the truth. A business with dangerous levels of debt in a slow-growing industry that is fundamentally losing the technology and data war against big tech. That's not resilience. That's a high-stakes gamble. And it's not a smart place for your money.
All right, let me wrap this up with some straight talk. My opponent just painted Lamar as some dinosaur company drowning in debt while TikTok steals all the ad money. Here's what they're missing. First, yes, advertising can get cut in recessions. But you know what doesn't get cut? People driving to work, going to McDonald's, heading to the mall, and every single one of those trips? They're seeing Lamar's billboards. You can skip a YouTube ad, block a Facebook post, but try ignoring a 50-foot billboard when you're stuck in traffic. Good luck with that. Second, this whole data war argument is like saying a hammer is useless because we invented screwdrivers. Facebook knows what you clicked last night. Lamar knows you're driving past their sign right now heading to buy groceries. Different jobs, both valuable. And about that debt? Look, every successful real estate company uses leverage. The difference is, Lamar's properties don't need plumbers or new roofs every few years. They just need electricity and occasional paint. Simple business, steady cash flow. Here's the bottom line. When you buy Lamar, you're not gambling on the next hot tech stock that could crash tomorrow. You're buying prime real estate that's been making money for over a century, now supercharged with digital tech, paying you 5% while you wait. My opponent wants you to fear change. I say embrace the companies that adapt and thrive through it. That's Lamar. That's your money's new home.
Thanks for that colorful wrap-up, but let's end this debate with some real talk and a dash of reality check. My opponent says you can't ignore a 50-foot billboard in traffic. True, but here's the funny part. In a recession, advertisers can and do ignore paying for it. It's like owning a fancy yacht that everyone admires but no one rents when times get tough. Lamar's got that massive debt hanging like an anchor, and when ad budgets sink, so does their cash flow. And comparing billboards to a hammer in a world of power tools? Cute, but digital ads are the power tools. Precise, trackable, and way cheaper. Lamar's prime real estate needs constant cash to stay upright, while tech giants like Google are building empires without the rust. Bottom line, investing in LAMR is like betting on fax machines in the smartphone era. Nostalgic, but not smart. Skip the risks, folks. Your portfolio deserves better than a debt-loaded dinosaur. Thanks.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye!